The guy that was supposed to be the next Warren Buffett, or people call him the Stanley Druckenmiller of our generation, has pretty much blown up in his fund and he had to sell a lot of stocks at major losses. And I think there's an amazing lesson here for a lot of the newer investors that are investing in the market. The OpenAI researcher Leopod is unwinding many of his positions after big losses on AI and a bad bet on software stocks that left him scrambling to raise cash. He has sustained significant losses in recent weeks because of his investments in AI infrastructure, such as SK Hynix. But while he was long SK Hynix and Micron and all those companies, he was also short software like Adobe's and other kind of companies. And you had the opposite thing happen over the last few weeks, where Adobe and the stocks he was short were going up, and Micron and SK Hynix were crashing like never before. It was a very bad position to be in, and he has suffered those losses. But the worst part about it is he was using a lot of leverage in his fund. And it says several of the firm's prime brokers have been working with the fund as it seeks to meet margin requirement or reduce positions in an orderly fashion. He has been rushing to raise cash to meet the margin requirement. So Ken Griffin's Citadel fund, he pretty much bought his public assets. He likely bought them at a major discount to the public price. And this is really bad, guys. But it's not the first time it happened. It happened back in 1998, 1999 with a firm called LTCM, Long-Term Capital Management. They were really smart people. As you could see here, they were outperforming the S&P and people looking up to them, and they were the best thing ever. And they pretty much blew up overnight only because they used a lot of leverage. And I think the lesson here isn't really don't use leverage. I think most of you guys know that. But I pretty much did it very honest when we had the top in the market 2 weeks ago. I said 3 dangerous investing mistakes to avoid. And I pretty much highlighted the trades of momentum investing, how people were looking at a lot of those like Serenity on X and other people up 200% year to date, 100%. Then they look at their own portfolio. They start comparing themselves to others. They start feeling bad. They start feeling that maybe they're doing something that's not working. Maybe value investing is dead. Maybe fundamentals don't matter. Maybe this time is different because we have the algorithms and we have AI. So we have to sell the boring stocks, buy AI when everyone else is buying them, and buy Rocket Lab at 120 when everyone's buying Rocket Lab and SpaceX is going IPO. And whenever you have such trades, they are so popular, so obvious, a lot of it is likely priced in. But a lot of the newer investors kind of don't know that, and they get influenced, they get out of their discipline, and they've been in this discipline for many years, and they lose a lot of money. And I'm sure there's many more people like Leopod. Maybe they didn't blow up, but maybe a lot of the newer investors that were just tempted to get out of their discipline, out of their own strategy or their ETFs, just because they were seeing someone else getting rich on X while they weren't doing too much. And it's always, what I try to tell a lot of people is I personally don't compare myself to others. Like if someone else is up 50 or 70% or 200%, I wish them the best. They're likely using a lot of leverage, and they're only showing me when they're having a good year, because we all in the market have good years and bad years. There's no oracle, there's no guy that doesn't miss. All those things don't exist. We just have good years, we have bad years, all of us. Even Warren Buffett has good years and bad years. But the trick is not to blow up in the bad years and survive, and do your best in the good years. And this is how you outperform the S&P 500 over the long term, and this is how you don't blow up. It's very simple. The reason why Buffett is the best investor of all time isn't because he delivered the highest return. His average return was 20%. Stanley Druckenmiller's return is like 35% a year. But the reason why Buffett is the best is because he returned 20% for like 65 or 70 years. So being able to be so consistent, consistency always beats chasing high returns and taking crazy risks that you're not aware of just because you got influenced by someone else that's only showing you how they're doing in a good year, but maybe they blew up 2 years ago or in 2022 and you don't know that, and you get influenced and you get hurt once they have all those bad years. And this is something that bothers me a lot because I've seen so many investors, asking me, do fundamentals still matter? Look at this guy, is up to 100%. Look at the AI is different. Maybe now things are different. It's really never different, guys. And those old school principles always apply. But for me personally, I don't compare myself to others. If someone's up to 100%, is I'm happy for them. I just go on this calculator called investors.gov, and mainly a compound interest calculator. You put in the initial investment, monthly contribution, length of years, and your potential return, and it gives you your number. And if this is maybe close to your dream number, then you know how much money you need to invest, and you know your potential annual return required to achieve this number. To some of you guys, it could be 8%. If 8%, then the S&P is better. If it's maybe 12 or 15%, that may be some quality and growth. To some of you, it could be 25, 30%. To each person is different. For me personally, my goal is 20% a year, 20, 25%. The last 4 years, I was fortunate enough, I got a 32% average annual return. But I know this is not going to be sustainable forever. And as long as I get close to my 20% average annual return, then I don't care if someone's up 70 or 90%. I wish them the best, and I hope they survive in the bad times. But for me, I'm here to survive in the good times, the bad times, try to exceed and do my best when I'm having a good year, and try to survive when I'm having a bad year and not blow it up, because we're all going to have those good years and bad years. There's no, oracle or the guy that doesn't miss and all these things. And I think that's a very valuable lesson in general. Like just leave other people alone. Let them do their own thing. Let them take on leverage, and don't use leverage. Leverage is very, very dangerous. The only leverage I use personally is options, because with options, you know what is your max loss and you know how much you could potentially make. It's a asymmetrical bet where your downside is limited. If I'm risking $300, I can only lose 300, but I can make $3,000, $5,000, $10,000. But I know my max loss is 300. This is a much better way, in my opinion, to use leverage if you want to use leverage, versus just, going on margin and doing all kind of crazy things because of the momentum investing trade, which work until it doesn't. And that was just a short video. It's probably not going to get a lot of views, but again, hope you guys enjoyed it, especially the newer investors. Thank you for watching me, not financial advice, of course, and I'll talk to you in another video.